Take a look at this chart. On the left is the $1.6 million financial experts say you need to retire comfortably. On the right is the actual median 401k balance for Americans aged 65 and older, just $95,000. To understand why that gap is so massive, we have to look back to the 1950s. If you worked on an assembly line or in an office back then, your retirement was likely guaranteed by a corporate pension. Companies promised their workers a steady, lifetime income in exchange for decades of loyalty. The institution carried the financial burden, not the individual. But that system was built on the assumption that these massive corporations would stay highly profitable forever. When companies started struggling, those pension funds dried up. Thousands of workers lost their life savings overnight. And when high-profile union leaders like Jimmy Hoffa were caught siphoning pension money to fund mob-run casinos, public trust in the system collapsed. By 1974, the federal government had to step in. President Gerald Ford signed strict new regulations to protect workers, requiring companies to fully fund their pensions and maintain heavy transparency. The new rules worked to protect capital, but they also made pensions incredibly expensive for businesses to maintain. Around this same time, a minor provision was added to the tax code, Section 401k. It wasn't designed for the average worker. It was written so wealthy executives could defer paying taxes on their end-of-year bonuses. You would perk the extra cash in a special account, let it grow tax-free, and worry about the IRS later. Corporate boards quickly realized this executive loophole could solve their pension problem. By buffering a 401k, companies shifted the entire financial risk of market crashes and bad investments away from themselves and onto their employees. The burden of funding retirement ran it squarely on the shoulders of workers who had no formal training in wealth management. Today, the 401k is sold to employees using one incredibly effective marketing hook, the employer match. If you put a percentage of your paycheck into the account, your company promises a match. It sounds like free money added directly to your compensation package. But that money comes with serious strings attached. Most companies use what is called a vesting schedule. This is a legally binding timeline that dictates when you actually own the money your employer put into your account. This chart shows how a typical 6-year graded vesting schedule works. After your first year, you own exactly 0% of that match. By year 2, you might keep 20%. You don't fully own the employer contributions until you stay at that specific job for 6 consecutive years. If you leave early for a better opportunity, you forfeit the unvested cash right back to the company. Then there is the cost to keep the account open. When you invest in a 401k, you are restricted to a small menu of pre-selected mutual funds. These funds charge management and administrative fees, often buried deep in the fine print. This graph compares a 0% fee portfolio against one with a seemingly tiny 1% annual fee. Over 30 years, that fee compounds, opening a gap that erases a full quarter of your total portfolio value. The structure is brilliantly effective for everyone except the employee. The vesting schedule keeps workers locked into their jobs, while the hidden fees automatically siphon a massive cut of their investment returns directly to the financial sector. The other major selling point of the 401k is the tax break. By contributing pre-tax dollars from your paycheck, you lower your taxable income today. The entire premise relies on a single assumption, that you will be in a lower tax bracket decades later when you finally retire and withdraw the money. Making that assumption today is mathematically dangerous. The federal government is currently carrying tens of trillions of dollars in debt. To service those obligations, future tax rates are highly likely to go up, meaning you could end up paying a higher percentage of your wealth to the IRS in retirement than you do right now. And the way that money is taxed matters. Look at this comparison. When you withdraw money from a 401k, the government taxes it as ordinary income. That is the highest possible rate. Most other investments are taxed at the long-term capital gains rate, which takes a significantly smaller percentage of your profits. If you realize this and try to pull your money out early, the system traps you. Accessing your own funds before you hit age 59 and a half triggers an immediate 10% penalty, right on top of your regular income tax bill. Even if you leave the money untouched, the government eventually forces your hand. Once you reach age 73, you are hit with required minimum distributions. This visualization shows the specific formula the IRS uses. They take your total portfolio balance and divide it by a life expectancy factor to calculate a specific amount you must withdraw every year.
You have to take the cash and pay the taxes, even if the market is crashing and you'd rather leave the money alone. Tax deferral is not tax avoidance. When you put money into a 401k, you are taking out an unpredictable, mandatory loan with the government, locking your personal wealth in a vault until the IRS decides exactly what interest rate you have to pay to get it back. None of this means the 401k is entirely useless. It forces you to invest consistently, exposing your cash to broad market growth that outpaces inflation. And if you stay at your company long enough to fully vest, the employer match is a legitimate mathematical gain. The problem occurs when you rely on it as your only wealth-building tool. You are severely constrained by strict government contribution limits, and you have virtually no control over what specific assets your money actually buys. To build a secure retirement, you need vehicles that offer control and liquidity. A standard brokerage account, for example, has zero contribution limits. You choose exactly what you invest in, and if an emergency hits or an opportunity arises, you can sell your assets and access your cash immediately, without paying early withdrawal penalties. Real estate offers another powerful alternative. Rental property generates monthly cash flow and provides tax write-offs like depreciation, shielding a large portion of your income from the IRS. Crucially, both brokerage accounts and real estate investments benefit from that lower long-term capital gains tax rate. When it comes time to actually use your money, you get to keep a much higher percentage of the wealth you spent decades building. True financial independence requires flexibility. Relying entirely on a 401k leaves you vulnerable to hit. It is built by treating the 401k as just one flawed gear inside a much larger, individually controlled financial machine.